Welcome back. With little sign of interest rates coming down in Canada, how are consumers holding up? Here's a look by the numbers. Consumer debt continued to grow, hitting a record $2.5 trillion, held by 32 million Canadians at the end of last year. That's up 4.5% year over year, according to TransUnion. Credit card balances jumped 9.2%. Younger Canadians are the fastest growing segment for debt holders, a 29% increase in participation for Gen Z alone. Average credit card debt per borrower was $4,681 at the end of last year, and delinquency rates are also up 1.8% to a 5-year high, with Gen Z helping drive those numbers higher too. Meanwhile, 60% of mortgages will renew this year or next, and many will see higher rates, especially those with fixed-rate 5-year mortgages. The Bank of Canada says the average monthly payment could climb 10% for renewals in 2025 and 6% for those renewing in 2026. But that masks a big difference in mortgage type. Fixed mortgage holders could see increases of up to 20% compared with a December 2024 payment. Those with variable rate mortgages could actually see declines of 5 to 7%. Those rising mortgage rates are also making it harder for many to buy a home. Ratehub says affordability worsened in 12 of 13 major markets. Only Toronto saw an improvement in affordability in June. Most mortgage holders, of course, will face an increase in costs in the coming years. So what is the ripple effect of those jumps? Penelope Graham is head of content at Ratehub.ca. Penelope, thanks for being with us.
Hi, thanks for having me.
So it's not going to be news to people that hold these mortgages. If you took a mortgage out in 20 or 21, rates were very low, and you will know that you're probably facing a reset at a higher level, in some cases much higher. But just put it into context for us of how big a hit to the system it is when we see that big a jump in payments for so many people.
So this phenomenon that we refer to as the mortgage renewal cliff or wall, it really started to become a concern in the latter half of 2022 and throughout 2023, because of course interest rates started to rise exponentially from those record lows during the pandemic, and many Canadians had taken out their mortgages at that time for next to nothing. Fast forward to today, and all of those 5-year fixed terms are now coming up for renewal. Bank of Canada has come out with that analysis that 60% of those who are renewing this year and next are going to face higher payments. So Ratehub did some additional calculations to see how these payments are going to differ compared to the lowest rate you would have taken out in 2020 versus today. And what we found is if you took out a fixed rate mortgage in 2020, you would have had an option to take out a rate at 1.89%. Well, today, the lowest rate you could take out is 200 basis points higher. It's now up to 3.89%. And what that translates into is actually a 19% increase in your monthly mortgage payment. And from a dollar perspective, you're looking at paying $436 more per month on your mortgage, and that equals out to just over $5,200 a year. That is not an insignificant shock for many households to absorb.
It is
on
not
the variable mortgage.
Sorry, I just want to jump in and say it's not, the change, of course, is not insignificant. However, a lot of people would have seen it coming and, of course, hopefully understood when they took mortgages out below 2% that they were getting the deal of a lifetime. Do you think that people have adjusted their spending, their savings, their household income in order to account for the fact that those costs are going to go up?
Well, we have had a couple of years of leeway understanding that rates are going to be in a much higher interest rate environment this year and next. The most important thing you can do as a renewing borrower, if you know that your monthly payments are going to be higher, is to be proactive. And that means taking initiative, 6 months out from your renewal date to start exploring your options. Because if you can secure a slightly lower mortgage rate, even just shaving a few basis points off can equal hundreds or even thousands of dollars saved on your mortgage. So what that looks like, connecting with a mortgage broker, exploring your options potentially with other lenders. Are they offering a more competitive interest rate than what you might be receiving from your existing lender?
Right.
It's common knowledge that they save the most competitive rates for new clients. Taking out things like a rate hold or a pre-approval to guarantee access to today's pricing, because we are starting to see evidence that both fixed and variable mortgage rates could be poised to rise in the coming months or stay stagnant. We're certainly have left behind the most recent rate cutting cycle from the Bank of Canada. So borrowers need to be mentally prepared for interest rates to not offer much relief.
And I do want to ask what happens for those who are looking maybe to even check in with a broker, a change mortgage provider, if the value of their home has come down, as it has in many cases, Penelope. What happens if your mortgage is getting more expensive, but the value of your home is coming down? Does that have an immediate impact on people looking to renew?
Certainly. So that presents what we call appraisal risk. And if you're underwater on your mortgage, if you now actually owe more in terms of what the home is worth, that can certainly complicate your mortgage renewal. The best piece of advice is to communicate early with your lender about what your options are if you're truly at risk of default. They're going to work with you. It is in their best interest for you to not default on your payments or have to foreclose on your home. And there are certainly options that you can explore, such as extending your mortgage amortization. This will in turn shrink your monthly payments, perhaps to something that's more manageable. Therefore, you're more liquid month to month with the budget. But the trade-off there is more interest paid over the lifetime of your mortgage. But the takeaway here is to communicate about this early with your lender.
So good to have you, Penelope. Appreciate your time.
My pleasure. Thank you.
Penelope Graham is head of content at Ratehub.ca. Well, it's a bad time for a recession with costs still high and rates likely to stay put, at least for now. Is that a perfect storm for people in debt? Wesley Cowan is a senior VP at MNP. Thanks for being with us.
Well, thanks for having me.
So let's just start with whether things do feel a little bit shaky for people who might have been hoping for relief in terms of the rates that is maybe not going to come now, certainly not through the fall.
Yeah, it certainly seems that way. I mean, rates are going to stay, would seem to be consistent now for a while. And, for a lot of Canadians, about 2/3 of Canadians say that they still would want rates to go down. They're still somewhat desperate for that to happen. So there's still, even though rates have come down compared to what they were a year or so ago, a lot of Canadians feel that it could be even lower, and that would help a lot.
We've definitely been talking here about the rising costs for a lot of mortgage holders, especially those with fixed rate mortgages. What are you watching in terms of kind of your client base, but also potential client base, for signs of trouble? Where does it tend to show up first?
Yeah, and this is an area we are watching fairly carefully, because a lot of folks that bought houses or remortgaged during the pandemic, a lot of those mortgages are coming up for renewal soon. And, even though interest rates have relaxed a bit compared to what they were, they're still considerably higher than what people originally got their mortgages at. And so that could mean a fairly substantial monthly increase in their mortgage payment. And that's going to put a strain on their financial affairs, on their budget, and their ability to pay other debts. And so that's where things could sort of start to slide a bit, and we're looking at that pretty carefully.
And as I understand it, credit cards is usually one place we let slide first, even though it's the most expensive thing. It's the worst thing to do, but of course we pay off our mortgage before everything else as a rule. Have we seen credit card insolvency rising?
Well, it's one of the things that's happened for a lot of folks is that, if they don't have the ability to extract equity out of their house, out of their property, they'll turn to unsecured credit a lot of times with credit cards, because they are easy to use. And, it's easy to sort of let that get away sometimes. And so, making up the difference in income, or maybe if there were expenses that you didn't anticipate you were going to have, using credit cards. And as you point out, credit card interest is typically very high. And if you're only making the minimum payment, you're not going to be able to pay the balance down very quickly.
In the mix of all of this, of course, is this fear about this recession. Even a mild one could put some jobs at risk. We know people are afraid for their jobs right now in a sort of a new way. How closely do you watch the labor market for signs that will turn into folks that really can't manage their debt?
Sure, it's a fairly significant thing, and certainly in our most recent MNP Consumer Debt Index, the quarterly Ipsos survey that we do with folks, they're talking about some of the concerns that they have around this, and the possibility of, layoffs or losing their jobs, particularly given the backdrop of global volatility with what's happening with the U.S. administration and some of the pressures there. Really, it comes down to just this sense of uncertainty about what's going to lie ahead.
And just really quickly here, would you expect things to get worse for debtors in the months ahead, or are we seeing things slightly improve?
Well, it's interesting. It's kind of a mix right now. A lot of folks are reporting that they are still concerned about their financial position. About a third of Canadian respondents in our survey said that they were anxious or stressed about their financial situation. But there was also some optimism. About a third of the people responded to say that they expect their debt situation could improve within a year, and about 40% felt it would improve within 5 years. So there is some optimism there. It's not all doom and gloom. So it's a bit of a balance right now between those things.
So good to have you for this, Wesley. Appreciate your time today.
Thanks very much.
Wesley Cowan is a senior VP at MNP. Coming up, a risk expert weighs in on the challenges ahead for Canada. That's still ahead. But first, leave it to Elon Musk to push the frontiers of anxiety around AI by announcing a child-friendly version of his own AI, Grok. He unleashed a torrent of fear about children being exposed to this technology. Grok is Elon's effort to keep up with the Joneses of AI, but has more limited data sets for training and primarily relies on content from Twitter X. In other words, a lot of trash, just what you want to feed your small children. The internet reacted the way you'd expect it to, which has us wondering if Kinder Grok is more publicity stunt than genuine offering, or in the vernacular of the medium, rage bait. We're back after this.